Everybody, it is Friday, the 12th of October, 2018. Hope you made it through this week okay. The S&P 500 lost 4%, NASDAQ down 3, Russell 2000 down 5%. Just a rough week all around for equities. The bonds did bounce back a little bit, and the volatility index, of course, was higher. And this has been a tough month for bulls so far. We're barely managing to hold on to gains in the Russell 2000. Semiconductors are down on the year, so let's take a look at the action. The S&P 500, this is a year-to-date chart basically, and what I have here are some volume-weighted average price levels, and they all kind of came together near that 274-ish area. Frank Zarilla pointed that out on Twitter also, that the year-to-date the VWAP off of the prior peak, the prior low, and then off of this peak, all kind of tied together in there. And when we look at a daily chart, we can see that this year we have had some pretty strong pullbacks. They've all been quick, and they have bounced back. It's taken some time for these previous two, but we had a 12% decline, a 9% decline, and this one has shown a low so far. Who knows if it's going to go further or not, of down not 8%. So when we look at this daily chart, again, here's the 200-day moving average. The actual value of that is 276.26, and today we closed just below that. So this is the first weekly close below the 200-day moving average, I believe, all year. If we take a look at that weekly chart, you can see that's the green moving average. And what we have is, on the weekly time frame, still a longer-term uptrend, but we're showing signs of being tired. And came into the week with a little bit of caution. Actually, we were in a cautious mode because we were below the declining 5-day moving average. This is Monday, and you can see I have a VWAP anchored from that. The average price the S&P traded at this week was 279.18-ish or so, right around in there. So this week has been, it pays once again to be cautious when the 5-day moving average is declining. I consider the intermediate term guilty till proven innocent when we have a declining 5-day moving average. That means we don't trust rally attempts. And, now maybe we're starting to show some signs of stability just after going sideways for 2 days. But again, let's go back to the prior sell-offs. And actually, let's look at this other chart where I had that outlined. The prior two sell-offs right here, you can see that, the way they occurred in the subsequent recoveries, it wasn't all at once. And in fact, it looked like the worst might have been over after this gap lower and then a new move higher. But then 2 days later, the lows were taken out once again. And same with this one, the lows were taken out. So looking at the S&P 500, a lot of people are looking at it saying it's down too much, it's got to bounce, and that sort of thing. The market doesn't have to do anything. What we need to do is respect the market and decide to, play a strong defense when the market gets very volatile the way it has this week. Maybe you got involved, somewhere in these areas, and perhaps you're in near the low. But to me, it's better to be safe and wait for actual evidence that buyers are gaining control. And from an intermediate term perspective, that means we need to be back above a flat to advancing 5-day moving average. That's going to take some time for that to happen. On Monday we get rid of this data in that 5-day calculation, so we'd have to be above there just to have it break, the 5-day flatten out. And I don't think that's likely. So going into next week, we remain quite cautious. Yes, we've sold down a lot quickly, but maybe another undercut of this low, perhaps. I like to kind of sketch in potential scenarios. They're not meant to be predictions, but here's something that maybe could happen. Maybe we run up to the volume weighted average price from this week, kind of do something like this, and then we would see, the volume weighted average price off the low, for instance. That could start to turn higher like this, and then we would see that flatten out, and then the S&P kind of does something like this and gets trapped under there, and then maybe we get a bigger flush out Tuesday into Wednesday of next week. Who knows? Maybe something like that. But the point is, we're not out of the woods here. Just because we're down a lot doesn't mean we're down, that we have to bounce. Or just because the year-to-date volume-weighted average price and 200-day moving average held on a closing basis for the week in the Nasdaq, it doesn't mean that we want to get bullish. The double top we spoke about, obviously, we saw it break down, it rallied up to that prior support, and then came crashing down. And on a 15-minute time frame, we see the same thing here. We have a declining 5-day moving average. It's interesting that, however, that the average price, the volume weighted average price since Monday of this week, we basically closed right on that, showing that relative to the S&P 500, it was actually a little bit stronger in its recovery. The volume weighted average price off the low, we pretty much held that for most of the day today. So maybe we get back at, the bearish scenario would be something that looks like this, and then undercut and retest. The bullish scenario would be maybe we start to see a 5-day moving average kind of do something like this in the next few days, and then it is able to break higher once it starts to turn back up. But my feeling is that, again, with a declining 5-day moving average, it's guilty till proven innocent. I would prefer to see a test of this low, meaning at least come down within, 5-10 cents of it, or undercut it slightly before it was able to turn higher again. The Russell 2000 really got decimated here. And again, for this market, looking at it, year to date, we're only up 75 basis points in the Russell 2000 after having most of the gains for the year erased just in the last 5 or 6 weeks. Here's a potential bullish scenario, but again, what we need to look at is what's the realistic scenario. And the reason I always say that we have a potential level of support at this prior resistance, which was support in here in the 200-day moving average. It's only potential support until we see that prices actually stabilize and begin to turn higher. And that didn't happen in the Russell 2000. We tried to stabilize a little bit in that 162 area, but the declining 5-day moving average said there is no reason to trust this, to think that it can turn higher. We were on alert maybe for something like this to occur, but it didn't occur. So instead, rather than playing guessing games that it's the bottom and waiting for evidence, that type of sell-off, can be avoided. This market, on a relative basis, obviously much weaker. It closed well below the week-to-date volume-weighted average price in here. So I think that if this market bounces for a day or two, then maybe it comes back down and retests it once again. So we are not out of the woods, as I've said in the other markets. The semiconductors broke through what was supposed to be support right in here. I didn't think it made sense to short there. And, hindsight, it did. But hindsight's perfect. You have to talk about what's realistic in the moment. And did you actually have a good opportunity to short there after it looked like it was starting to stabilize at the week-to-date volume-weighted average price? And then we saw a gap lower on Wednesday. So realistically, I don't think that new shorts this week made sense in the semiconductors, not from a position of shorting after a decline like we saw of this magnitude. Sometimes it works, usually it does not. If it did for you, then great. Fill up my comments with how smart you are on YouTube if you like. But the fact is, we're here to talk about what's most reasonable expectations and what's most likely. Again, in this market, maybe we get a little bit further bounce, a test that undercuts slightly or comes down close to that low. I would prefer before we do get a rally attempt. The biotechs got smashed. They did end up fulfilling that double top pattern, meaning that the height of this pattern was exceeded on the downside, and that completes the double top basically that we spoke about last Friday. On a 15-minute time frame, we're still below a declining 5-day moving average, and I think the same scenario is likely in this market as well. Financials did close with a 3-penny gain today. However, it wasn't an easy gain for this market. It gapped higher. We saw some earnings in this group. It gapped higher and then sold off quickly. It did close above the VWAP here at the end of the day with this rally, but still for the week, we can see that, this market really got hit pretty hard. In fact, the financials lost 5.6%, which is the worst of all of these sectors and ETFs that I look at consistently. So financials, had the chance to be the savior of this market, perhaps this week, by getting back above this level, but instead they failed and they failed miserably. The energy names also got hurt, and this again shows why you don't buy an extended market, right? As it broke a new high for since the midsummer, it was extended. It already made a big move, and certainly I didn't expect a pull. I thought maybe a pullback would come down to the 20-day moving average or so, but it just kept going lower and lower. And this is why you don't try to pick bottoms. And I hope that you made it through the week okay. Visit alphatrends.net if you're interested in my daily analysis. I do this every day in stock picks as well. That'll do it. Have a good weekend.